This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
A Friday dive. Stocks sell off sharply in the last hour of trading, but the S&P and NASDAQ still score their 7th straight month of gains. For the Dow, the winning streak is 6.
The Great Divide. Is the sell-off in the bond market for real? We'll ask an expert if the glory days are over for U.S. Treasuries.
And conquering cancer, the promising treatments being developed by some of the world's biggest drug companies to fight the deadliest forms of the disease. We have all that and more tonight on Nightly Business Report for Friday, May 31st.
And good evening, everyone. Welcome. The month of May felt more like the month of March today, going out like a lion on Wall Street. The selling was modest for most of the session, but then in the last hour, it hit hard, wave after wave, as portfolio managers made month-end moves and certain indexes were rebalanced. That can lead to wild swings in individual stocks, and that's just what we got. Today's range from high to low on the Dow, 277 points, was the biggest since January 2nd. When all was said and done, the Dow finished 209 points lower, its worst performance since the day of the Boston bombings. The NASDAQ was down 35, and the S&P 500 was lower by 23. All three finished with losses for the week. Nevertheless, each of those major barometers ended the month of May with gains, the first time that's happened since 2009. The monthly win streak now, as we mentioned, stands at 7 for the S&P and the NASDAQ, 6 for the Dow.
Here to put the market moves in perspective, we have Jeremy Siegel, finance professor at the Wharton School, the University of Pennsylvania. Jeremy, you are predicting that the Dow gets to as much as 17,000 by the end of the year. Right now it's at 15,000. What is going to drive that kind of growth, and why are you so bullish on a day like this?
Well, as you guys mentioned, the end of the month, a lot of repositioning takes place. We did have a brutal week on yields, and what I really think is happening is the market is really pricing in the tapering of quantitative easing. And since so many people think that that's the source of the big gains, clearly there's going to be nervousness on that. But I think that it's gotten priced in pretty reasonably. I don't think it's quite as damaging as I thought it might be. Now, we'll wait till next week to see whether there's some carry through here. But you're right. I certainly don't think the highs have been reached. I'm still believe that we're going to end up the year between 16 and 17,000. On the Dow, and it's going to be mainly two factors. It's going to be good earnings, but multiple expansion. And even with rising yields, they are still so dramatically low. We can have multiples of 18, 19, and even 20 and not be at all unusual in a low interest rate environment.
So earlier this week, Professor, we had Mohamed El-Arian on, and he was concerned about the fundamentals. He was concerned about whether there was sufficient growth in the economy and corporate profits to justify stock prices at this level. That's why he says he's walking away from risk. How would you answer him?
Well, first of all, I don't believe we need big increases in corporate profits and earnings to justify even higher levels of stock prices. Don't forget, firms are buying back shares, so earnings per share is going up. There's a dividend yield that is over 2%, which is attracting more and more people, has a tax preference. If we get capital gains of 3, 4, 5%, it's going to beat bonds hands down. So I don't know where Mohammed is going to go with his money. I think PIMCO has already said the bull market is over on treasuries, so the move isn't there. Commodities look wobbly to me. We've seen what can happen to gold. It's not always the safest commodity. I still think stocks are going to be the asset of choice for most Americans.
Jeremy, real quickly, next Friday we get that important jobs report, and
Yeah.
all week long next week, people are going to be anticipating that. So how is that going to set the tone for the week and for the month of June?
Well, it's the single most important report. I guess the morning line is what, 170, 180, and it'll move one way or the other. But, you know, most of what I see is that we are in a period of moderate growth, and given the fiscal drag with the taxes and sequestration, people are pretty amazed at how strong the private economy is, and that's what's going to drive us in the second half.
All right, we're going to have to leave it there. Have a great weekend. Thank you so much. Jeremy
Thank you.
Siegel from the Wharton School.
Well, one of the reasons stocks have been jittery this week is that sharp rise in bond yields that Professor Siegel was just talking about. In fact, at one point today, the 10-year Treasury note broke through 2.2%. It's risen nearly a half percentage point in just the past 5 weeks. All of this is causing a great divide on Wall Street on whether the greatest bull run ever for bonds may be coming to an end. Hampton Pearson takes a look now.
The last trading day in May saw both sides of the debate over the long-anticipated bond market sell-off play out in the markets. Treasury prices dropped after the Institute for Supply Management, a closely watched barometer of business activity, increased sharply last month, a sign the economy is getting stronger. An improving economy adding to Wall Street jitters after comments from Ben Bernanke and other Fed officials about plans to taper its bond purchases. Goldman Sachs fixed income analysts point to yields consistently above 2% on the closely watched 10-year Treasury bonds in a note today telling investors the bond sell-off, it's for real. On the flip side, UBS analysts countering. The market seems to be overreacting to the slim possibility that the Fed could begin tapering fairly soon. The net result this week, volatility. Not good, Wall Street watchers say, for stocks or bonds.
Equity markets do not like when bond rates move this fast. If we creep higher in interest rates, which is my view, I think stocks will be fine. It's this gallop higher that has equity investors concerned. And I don't think we can make positive progress if 10-year treasuries keep moving up.
The housing market is already feeling the heat. Mortgage interest rates reached their highest point in more than a year, now close to 4%.
Next Friday's jobs report could be the next market mover. That payroll number could determine if there's more room for bond rates to move higher or if the recent sell-off is overdone. For Nightly Business Report, I'm Hampton Pearson in Washington.
So are the bond market's big glory days behind it? Bill Irving is a fixed income portfolio manager at Fidelity. Mr. Irving, welcome. Where do you stand on the sort of fracture there between UBS on the one hand, saying the worry is overdone, and Goldman on the other saying this time it's for real, the bond bull may be on its last legs?
Well, certainly the backup in yields this past month has been sharper and more sudden than I think many market participants expected. But in my opinion, the backup so far has been both healthy and reasonable. And what I mean by that, if you go back to the beginning of May, on the one hand, the yield on a 10-year Treasury was only 20 basis points above its all-time low. It was around 1.6%. Meanwhile, at the same time, the recovery continues to take hold. We had a very strong employment report this past month. Household balance sheets are improving. The fiscal outlook in the United States is improving. All good. So those two things were inconsistent. And then more recently, you have had the Fed rhetoric, which has made clear to the market that the quantitative easing program is not going to last forever, and they're going to begin tapering their purchases either in September or I would say by December of this year. So for those two reasons, I think, contributed to the sell-off we've seen in the bond market. Having said that,
but Bill, should you, this is Susie, should you, if you're an investor and you've been holding bonds, should you keep holding on to them or should you sell? I mean, a lot of people really believe that it's safer to keep your money in those bond funds. But can you make money with Treasury yields at 2% and inflation around 2%?
I think that yields will continue to rise throughout this year as the recovery continues to normalize. But I don't think it's going to be a straight path to higher yields, and I don't think it's going to happen as sharply as what we've seen this past month. I think that we're in a more volatile environment where interest rates are going to be more sensitive to the economic data. So, for instance, if next Friday we get a payroll report where we've added 250,000 jobs, I think it is possible, the 10-year yield could rise, say, 20 basis points. But on the other hand, if we get a disappointing number, I think we could go right back to 1.8% on the 10-year yield.
There's really been almost a 30-year bull market in bonds, Bill. I don't have to tell you that, but certainly over the past 10 years, an awful lot of people have made a tremendous amount of capital gains in their bonds and bond fund holdings. Do you think that era is over and that people ought to reset their expectations in terms of the returns they might derive from their bond funds?
Absolutely. That is, I think, the most important point. A starting point to estimate what returns might be going forward. The yield on the aggregate, the Barclays aggregate, which is a broad investment grade bond index, is around 2%. So if yields stay just where they are, then over the next year you can expect about a 2% return. And if yields rise, then that's going to eat into that return. And so they could be lower, they could even be negative. So I think the most important point is the strong returns that bond investors have enjoyed over the past several years, 5, 6, 7, 8% returns, they need to reset their expectations significantly lower.
All right, Bill, we have to leave it there. Thank you very much. Bill Irving of Fidelity tonight.
Some good news of sorts out of Washington today. The government said that Medicare's hospital trust fund won't run out until the year 2026. That's 2 years later than previously forecast. The date when the Social Security will exhaust its trust fund remains unchanged at the year 2033. But as more and more baby boomers retire, Treasury Secretary Jack Lew sounded cautious about the long-term prospects to keep those trusts funded in the future.
Social Security and Medicare are meeting their commitments today, and they will continue to meet their commitments in the years ahead. Yet, as the trustees' reports have been indicating for a while now, these programs face long-term challenges.
President Obama urged Congress today to stop federal student loan rates from doubling as of July 1st. Interest rates of new subsidized Stafford loans are set to go from 3.4% to 6.8% in 1 month, which may put college out of reach for some Americans.
Because folks made their voices heard, Congress acted to keep interest rates low. But they only did it for a year, and that year is almost up. So the test here is simple. We've got to make sure that federal student loan rates don't double on July 1st.
Both Republican and Democrat lawmakers say they want to avoid the increase, but they can't reach an agreement just yet on how to do it.
The Organization of Petroleum Exporting Countries, or OPEC as we know it as, met today to decide on what to do about oil prices. The group decided not to raise output beyond the current 30 million barrels a day. OPEC pumps about a third of the world's oil, but the boom in U.S. production has blunted the group's clout. Brent oil sits right at $100 a barrel, the favored price floor that OPEC is known to desire.
And coming up, battling cancer, what 3 of the world's biggest drug companies are doing to fight some of the deadliest forms of the disease. But first, a look at the top performing sectors this month. And it was a good month for most of them.
Shares of cancer drug developer Epizyme soared in their first day of trading after the biotech company raised more than $77 million in its initial public stock offering. Shares opened at $15 apiece at the high end of its expected range and closed 53% higher at $22.99.
Well, Susie, new medications and treatments to fight cancer are the focus at the annual ASCO Oncologist meeting that kicks off in Chicago today. It is one of the world's largest gatherings of biotech companies, pharmaceutical giants, cancer care specialists, and Wall Street investors all looking at what new drugs are getting the attention of top cancer care doctors and researchers. Bertha Coombs now with more.
The American Society of Clinical Oncology annual meeting is one of the most important events in cancer research, where drug companies present the latest data on promising treatments for the deadliest cancers. That has made it a key meeting for investors.
A dozen companies or so are having analyst meetings over the weekend, at which point they'll also showcase their data. And that's a great time for investors and analysts to interact with the management teams.
This year, the most highly anticipated data is on treatments from 3 major drug makers, Bristol-Myers Squibb, Roche, and Merck, that harness the immune system to combat cancer.
We have new classes of drugs, such as the immunotherapies, which are advancing the treatment of potentially a variety of cancers, specifically melanoma, but being evaluated in kidney, breast, and lung cancer.
The drugs target a protein in cancer cells that binds with a receptor on T cells called PD-1, which stands for programmed death. That protein masks cancers from the immune system. The drugs block the protein, allowing the immune system to attack the cancer cells.
In some patients, you could end up with a cure for their lung cancer or for their melanoma from using these anti-PD-1 drugs, especially when you combine them with Bristol's currently marketed drug, Yervoy.
Preliminary data shows combining Yervoy with Bristol's new PD-1 drug shrank melanoma tumors more effectively than either drug alone. Merck's PD-1 drug results show it shrank melanoma tumors by 38%, while early results show Roche's PD-1 drug significantly shrank tumors in skin, lung, and kidney cancer patients.
The hope is that these drugs allow people to be more productive. I mean, it used to be that AIDS was a death sentence. Now, it's a lifelong disease.
All three drug makers will be reporting full trial results on Sunday. For Nightly Business Report, I'm Bertha Coombs.
On Monday, following that cancer conference, we'll speak with the CEO of Infinity Pharmaceuticals, which has seen its shares more than double over the past year.
Well, we start Market Focus tonight with a blue chip maker, Intel, a Dow gainer today on reports that Samsung has selected a new Intel processor for its latest Galaxy tablet that debuts June 20th. Shares of Intel were up about 2% before the sell-off, and it closed up a fraction at $24.28. The fight for Dell's future continues. The board has set a July 18th vote on founder Michael Dell's plan to take the company private. Meanwhile, Southeastern Asset Management, Dell's largest stakeholder, urged fellow shareholders to take no action when Dell's proxy materials show up in their mailboxes. Southeastern says it believes there's more per share value than Michael Dell's $13.65 offer. Shares of Dell closed near that offer price at $13.35 on double the normal volume today.
Retail stocks were in the spotlight today thanks to that upbeat report on consumer sentiment. It was the highest in almost 6 years. Investors are counting on more spending by more confident shoppers. But as the market sold off, investors backed away from companies like Macy's and JCPenney. American Eagle was flat, and only Gap held up a gain, up almost 1.5% to $40.55. And Lionsgate Films held on to gains today after reporting a quarterly profit and strong revenue from hit movies like Hunger Games and The Twilight Saga, both in theaters and home entertainment sales. Lionsgate closed at $28.80, up more than 2.5%. Our market monitor is positive about more rallies in the stock market, but he's also telling his clients to reduce risk in their portfolios. He's Jason Pride, Director of Investment Strategy at Glen Mead. Jason, nice to have you back with us. Want to get your take.
Thanks for having me, Susan.
Great to have you here. Want to get your take on these markets, and what are you going to be doing on Monday morning? Are you going to be buying more stocks?
Well, I think it's a cautious investment stance that we have. Really, we're looking at an environment where the Fed is really forcing investors to take risk. Markets are rallying probably more than the fundamentals actually reflect that they should. We're still in a good but not great growth environment. So we're wanting to take risk, but we're doing so in a cautious way. That means seeking stability, but still being an equity buyer through this period.
So some of the stocks that you have meet that criteria. And let's begin by just leaping in here. One of your choices is Philip Morris. I guess that's Philip Morris International as to be compared with Altria. Why do you like it?
So the main thinking here is we're going for dividends and stability. We're going for dividend growth. This is a 3% plus dividend yielder with a 10% growth potential in that underlying dividend. It's great when you can get that sort of an income plus the growth on top of it. It's a stable business. People's smoking habits, unfortunately, don't change through the times, and they also have a very substantial growth exposure. They have a large market going into emerging markets, and we think that's a huge growth opportunity for a lot of companies out there. The other two we're talking about meet that as well. Emerging market consumers are seeing 10 to 20% increases in their wages, and we know what consumers do when they make more money. They spend more money on everything from from toothpaste to cigarettes.
Well, talking about toothpaste, you have Colgate on your list. That's ticker symbol CL on the big board. The stock was down today, but it's been up sharply this year. It's the same investment theme, right?
Very similar investment thing. We're going for stability. You know, toothpaste and dishwasher. This is your staples. You don't really change your spending on this, except you may upgrade as your income increases. And this is a company that actually has a dramatic amount of emerging market exposure, primarily in Latin America, but also in East Asia. That growth is fairly strong. The dividend is solid, and the stability is there.
Maybe we should have saved Colgate for the last, because you eat before you brush your teeth. Your last choice is Yum Brands. That people eating a lot of chicken over in China. Yum has had some problems there with some food safety issues, but you see that as a short-term blip on its particular screen, I take it.
Correct. Now, this isn't a perfect stability one. You're still talking about a retail franchise. There's more volatility to it. It's a bigger growth opportunity because their presence in Asia is a lot stronger. They're tied to that consumer is a lot stronger. The interesting thing about Yum Brands in Asia is really the KFC brand, unlike its less cleanly image in the U.S., its image overseas and the stores themselves are considerably better. They're actually considered a little bit upscale by comparison to what they look like in the U.S., and we think that's a great growth opportunity. Anything attached to that emerging market consumer is a good story right now, as long as you're not really messing it up.
Jason, we have less than half a minute. Just want to get your take on that debate that we had at the top of the program. Do you buy bonds? Don't you buy bonds? You said reduce risk in your portfolio. Where do you stand on that?
We're not a big bond fan right now, at least not the traditional bonds. We think that hiding in the bunker and putting your money in cash and treasuries is probably the worst thing you can do when the Federal Reserve is basically punishing those that want to be the most defensive. You can't be doing that. But at the same time, investors can't just be blindly buying equities. You got to take risk, but take risk selectively.
Okay. Jason, any disclosures to make on the 3 stocks you were recommending?
So the 3 stocks, those are recommended. They're held by our mutual funds. They're held by Glenn Mead. I do not own them personally.
Okay, terrific. Jason Pride, Director of Investment Strategy at Glenn Mead. And still ahead on the program, what's it like on an oil rig when a major storm is about to strike? We'll take you to the middle of the Gulf of Mexico on the eve of hurricane season. But first, let's get a check on the top performing Dow stocks this month.
The Atlantic hurricane season officially begins tomorrow, and forecasters are calling for an active season with as many as 6 major storms. As residents and businesses prepare, the U.S. energy industry in the Gulf of Mexico is already on high alert. Scott Cohn is in Norco, Louisiana, with a look at some of the preparations already underway.
We're 30 miles out in the Gulf of Mexico, and this is one of Chevron's closest offshore facilities.
We have to be very diligent.
The South Timbaleer 52 platform produces around 2,900 barrels of oil per day. 60 people live and work here, 2 weeks on the rig, 2 weeks off, including operations supervisor David Bond, a 33-year offshore veteran who showed us around.
Would you like it out here? Oh, I love it out here.
Out here, hurricane preparations begin well before hurricane season. Even a tropical depression 200 miles away can trigger phase 1, moving non-essential workers and equipment.
In the event of a hurricane, we would have to get all this stuff rigged down. Should take us about a day and a half or so.
Then the non-essential workers are airlifted out, leaving a core group of production workers and supervisors to hold down the fort just a little bit longer.
As we finish out and go through our phase 2 process, well, then it starts to kind of hit home a little bit.
On a normal day, Chevron has about 2,500 people working in the Gulf. If a hurricane or even a tropical storm is approaching, pretty much all of them have to come ashore. That would be a huge challenge even on a good day. Now, they're racing against the weather and they're racing against time. They coordinate everything from this command center, opened in 2008, 100 miles inland in Covington, Louisiana. Mike Casey is in charge of operations.
We can now talk to every platform we've got, every asset we've got, whether it be a helicopter, a boat.
Back on the rig, final preparations are intense.
You just keep working through it.
In the control room, they make sure every well, every valve is shut and secure before they too leave their second home behind.
You're always thinking, will it be there when I come back?
In Covington, Louisiana, Scott Cohn for the Nightly Business Report.
And coming back can be much more complicated than the evacuation, because if a storm hits, they won't know right away exactly what they're coming back to. And if the forecasts hold, they could be doing a lot of that this year.
And finally tonight, some good news. The Earth was not destroyed by a giant asteroid today, but it was close. Scientists at NASA say that around 5 o'clock Eastern time today, the asteroid known as 1998 QE2, which is nearly 2 miles long and even has its own moon, flew past the Earth in its closest approach in at least 2 centuries. Luckily, the distance from our planet was 3.5 million miles away. So, Tyler, I don't know if that's too close for your comfort or not.
I looked, I watched. I was looking at my watch to see when it came by.
Here.
We're still here. It's all good.
Have a great weekend, everyone. I'm Susie Garrett. Thanks for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great weekend. We'll see you here on Monday evening.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media, we are TheStreet.com.
I'm Susie Garrett with the Nightly Business Report News Brief. On Wall Street, the month of May ended with a volatile sell-off as portfolio managers made month-end moves and index funds were rebalanced. That led to a sharp drop in the final hour of trading. The Dow lost 209 points, the Nasdaq was down by 35, and the S&P was lower by 23 points. But all 3 major averages finished higher for May. That's the first time that's happened since 2009. Consumer spending declined 0.2% in April, but business activity in the Midwest this month revved higher, while consumer confidence reached a 6-year high. The government says the Hospital Trust Fund for Medicare will last 2 years longer than earlier thought. And starting on Saturday, Starbucks will ban smoking within 25 feet of all of its coffee shops. Be sure to tune in to Nightly Business Report right here on your public television station.